Welcome, participants. Uh, I hope the subject for today, given the background of the amount of noise that is being made with the US tariffs, is an interesting conversation. So, welcome everyone. We'll be talking today about setting up business in India uh, on the mainland and in a special economic zone that is the GIFT City. So, welcome everyone. Moving on very quickly to give you a background about us. Uh, we at InCorp are an Ascentium company. So Ascentium is present across 22 strategic markets, including the larger Asia Pacific countries. We have 20,000 plus clients across the APAC region uh, and are being served by more than 2,000 dedicated people across the world. And our proposition is to provide business services to the larger SME pool operating in the Asia Pacific region. And we specialize especially in giving foreign businesses an entry into the countries that we operate on, especially in the Indian markets, and help them set up, help them navigate the challenges that a typical corporate follows, and give them solutions which range from taxation to structuring, and help them ensure that they do their business perfectly. Um, I'll quickly introduce the panel that is going to help you navigate this webinar. Moving on, uh, we have myself as the CEO for InCorp India. The reason I chaired this panel is because this subject is very, very close to my heart. For the last 25 years, as a chartered accountant and a company secretary, we've helped many businesses uh, set up in India, help them not only set up, do their compliances, do their advisory, but also to help them scale up and navigate the complex, so to speak, landscape that companies face in India. Uh, and I'm joined by a couple of very good specialists, starting with Bansi. Bansi heads our clients group at InCorp India. She's a chartered accountant with 14 plus years of experience and has expertise in end-to-end structuring, taxation, and identification of various models for entering into India. And after setup, she navigates and helps companies to ensure that their compliances and financial pieces and accounts and payroll, etc., are well in order. Also joined is our expert and our head for GIFT City, that is Meet. Again, a chartered accountant with 10 plus years of experience. And we were amongst the first people who set up our offices and presence in GIFT City. So he has 5 plus years of experience in GIFT City and assists business for entering into GIFT City. We have some very, very marquee clients, whether it is foreign universities, fintech firms, stock brokers, investment funds, who have set up through our advice into GIFT City. So that is Meet for you. And at the right time, each of these people will start helping you through the maze of India entry. Quickly, let me set the base for this entire seminar. Since it is about talking about options for companies and options for all of you to enter into India, I'd like to start by laying down the foundation as to why one has to look at India. So, why set up in India? And I'd like to start by saying that after you've heard the 6 key points that I'm highlighting, we should be actually concluding why not India, right? So, starting with the top 3 big key drivers, one is economic growth between 6 to 7%, despite the onslaught of US tariffs, and we'll quickly talk about it in the next few slides. The driver to this economic growth are two big macroeconomic drivers. One is a 22 million plus skilled workforce and a consumer spending economy, which is going to cross $4 trillion by 2030. And given this macro, I think the government is doing 3 things, right, to ensure that we reach and capitalize on this macroeconomic trend. One is the set of government initiatives that the government is trying to do with respect to ease of business, getting multiple entry points into India, whether it is SEZ, special economic zones, GIFT City, very, very favorable tax rate for companies entering into India. Then you have the entire production linked incentive scheme, where you get subsidies worth 4 to 6% of the production that you do for specific high growth sectors, and we'll talk about it. So that's the entire Make in India initiative, and then the entire Digital India, the entire payment infrastructure, which has been structured in such a way that online seamless instant payments are made, and that's why one can target the entire larger consumer spending economy. We have more than almost 92 million internet users in the country at this point in time. So that's why India is very, very attractive. Moving on, um, we'll talk about some of the key high growth industries. Obviously, we have participants joining us globally in multiple sectors. So, very, very clear. You may want to actually note it down that some of these sectors are very, very high growth. And I talked about the production linked incentive scheme. So, we have from automobiles to electronic vehicles and electronic manufacturing. So, some of these sectors, the top three that I spoke of, have production linked incentives within them, and we have more than 700 applications that have gone through for production linked incentives, and 200 of them are applicable to MSMEs, medium and small enterprises. Obviously, FMCG, anything that has got to do with consumer, is very, very big in India. uh, Financial services has got a very big boost after the favorable regulatory regime under GIFT City, where a lot of funds and international funds have got domiciled and re-domiciled into GIFT City. I'd like to spend a minute on the global capability centers. India has currently more than 1,600 GCCs. Almost 55% of the operational GCCs in the world operate out of India, and more than 42% of global corporations are doing end-to-end work in India. So these global capability centers are ranging from accounting to advisory to designing to design manufacturing to R&D. So if any of you are thinking of relocating into India to tap the base of skill labor, a low tax regime, and a high growth market, India is the place to be in terms of talent availability for GCCs. In fact, individual states are in announcing GCC policies to take advantage of this trend. Uh, Healthcare and pharmaceuticals obviously is a India is the pharmacy of the world post COVID. Everybody knows. So there's a very, very high sector. Needless to say about information technology, renewable energy, and infrastructure. And I just like to point out a couple of points on the US tariff that we've been talking of. So India actually has been hit by a reciprocal tariff of 26%, and it's not that bad compared to the other Southeast Asian countries like Vietnam, Bangladesh, etc. And two sectors which clearly stand out in terms of benefit for India is one is the textile sector, the telecom sector. I think these two sectors we are better positioned than a lot of the Southeast Asian countries like Vietnam, Bangladesh. Obviously, there are certain places where we are neutral. Pharma is another place where we are clearly going to be in a good reckoning. And to all of you, I want to tell you a couple of things. Right, India is negotiating, and I think probably India is. Going to be amongst the smarter nations who are going to negotiate a very good bilateral trade agreement with the US by the end of the year. And if that happens, certain sectors like agri, etc., which have been hit badly, right, as far as the reciprocal tariffs are concerned, will get better. All in all, a mix of being lower amongst the amongst the US tariffs, reciprocal tariffs, coupled with PLIs that have just got the production linked incentive schemes that have just been announced for specialty chemicals, footwear, textiles, etc. A combination of this, along with a good negotiation of the bilateral trade agreement with the US, would stand India in great stead from an India entry perspective for all of you for these some of these sectors. Right. Moving on very quickly, we have three jurisdictions within India where you can set up. One is the mainland, and we'll talk about it in a few minutes. And then you have the entire GIFT City platform, which of course Meet is going to talk about. But a couple of lines on that. It's situated in the state of Gujarat, close to the city of Ahmedabad, and it's a smart city having the best infrastructure, etc., and a separate regulatory framework which is typical of a tax haven. So it's like an approved tax haven status, 10 years tax benefits, etc., etc., in this place. And then you have a special economic zone, different industries based on the different zones and locations of various industries. Special economic zones have been identified across India where you could locate yourself and do business. And a lot of this is happening through this production linked incentive schemes. And Bansi is going to cover that for you. So, typically, broadly, you have multiple industries which are high growth in India, and you can set them up in three different locations: mainland India, in GIFT City, and in the special economic zones. Right. And just to sum it up all, if you move on, you will see that effectively, I'm just trying to because we have people joining from all over the world. We'll just sum it up for you in terms of six top cities where typically we've seen businesses coming into India. And each of them have a reason, have a driver, and I'll quickly touch upon each of these. So when it comes to Mumbai, Mumbai is basically the financial capital of the country. So typically, most of the financial services, consumer, etc., companies come into Mumbai or Delhi. Between both of them, they cover close to almost 20% of the GDP of the country, right? So Delhi again, not no sector specific stuff. A lot of services and a lot of big businesses enter into Delhi or Mumbai, right? Then you have Bangalore and Hyderabad. Essentially, needless to say, Bangalore is the Silicon Valley of the country. So a lot of stuff related to IT services, the GCCs, etc., come into Bangalore and into Hyderabad. That leaves us with Chennai and Pune. A lot of manufacturing, automotive manufacturing, automotive spare parts manufacturing, etc., chemicals, etc., come into Chennai and Pune. Apart from they become being also a hub for IT. So these are the top six sort of locations that become vital for companies to enter into India, and obviously then they settle themselves depending on the needs, etc., into multiple tier one, tier two cities as well. So just to sum it up, yeah. If we just move on, just to sum it up, we have a enabling infrastructure package, right, to do all of this. And I touched upon infrastructure in one of the slides earlier. From airports to seaports to railroads to educational and health infrastructure, you've all covered it. So whether it is getting the best skilled manpower from 40,000 plus colleges and 12,000 plus technical institutions, to being able to be connected across India through 48 airports, through 10 plus large seaports, through the second largest rail network and expanding in the country, you all got it covered. So as you would enter India, India itself is taking lots of steps, leaps and bounds to improve and become world class as far as its infrastructure is concerned, right? So that's about the infrastructure. To sum it up all, we have certain very high growth industries, right? We have the top six cities laid out, very infrastructurally well connected, a set of government incentives through PLIs, through mainland, GIFT City, and special economic zones, and ability to maneuver nicely the entire reciprocal tariff regime that US has put in. So, all in all, we are set very well to get India into a zone where a lot of foreign companies can enter into India despite the disruptive global macroeconomic regime as we are facing. And to move on, I'll just now invite Bansi to get started with the mainland piece, and then we'll have Meet to talk about the gift city, and then we'll sum it all up for you in terms of FAQs. So we've kept some time for FAQs, so you can keep on noting down your questions. We'll take it all of them towards the end, and we'll try and quickly wrap this up. Please go ahead, Bansi.
Thank you, Manish, for that insightful overview of India's growing strategic relevance and the tremendous opportunities it offers. I'm excited to take you guys forward on the key steps and the critical considerations for setting up in India. As most of you may be aware, India is often perceived as a complex market. This is not because the opportunities aren't clear, But the legal and the regulatory framework has been intricate as well as evolving. With multiple laws being applicable to a single entity, it's easy to feel overwhelmed at the very start of your India entry journey. That's the reason why having clear understanding of the legal and the regulatory landscape right from the very start is so important, which not only includes choosing the right entity type, but also a very tax effective business model, which makes your entire India entry journey smooth, compliant, and successful. Moving on, at InCorp India, we believe in simplifying the India entry journey for our clients by guiding them through three key steps, which also becomes the foundational backbone of your new entity in India. Step one, which is understanding the FEMA and the FDI regulations applicable to your proposed business activity in India. Step two, which is choosing the right business entity type. And step three, which is defining your ownership structure. And at the same time, ensuring that you have a business model which is tax effective. Moving on. So the step one, which is understanding FEMA regulations, has two key aspects to be considered. First one is the press note 3, and second is ensuring that you choose the right FDI route. So on step one, basically back in 2020, the government of India revisited the FDI policy. This was largely in response to the geopolitical tensions with the land bordering countries. Accordingly, a key regulation came into picture, which basically laid down that any entity or business beneficial owner who is a resident or a national of a country with whom India shares a land border shall be required to obtain prior regulatory approval before setting up an entity in India. What's important to note here is that this particular rule not only applies to the top level, but across the entire shareholding structure. Hence, even if a single share is held by a business beneficial owner or an entity from these land bordering countries, he shall be required to obtain prior regulatory approval before bringing in the FDI. Also, this rule would apply in case of any transfer of ownership, whether it's a new investment or an existing one. Moving on is understanding the FDI regulations. Now, here there are majorly two routes which are defined. First one is a government route where prior government approval is required. And this is basically covering key sectors which are sensitive from national security or data standpoint. To name some, it is defense, print media, broadcasting content, certain segments of pharmaceuticals, etc. Moving on, the second route is automatic route, which is kind of very straightforward because no prior regulatory approval is required, and it covers most of the popular businesses among international audience, which is manufacturing, wholesale trading, construction development, information technology, financial services. So this basically ensures that most of such segments have a very straightforward process of setting up in India. So, what is important to note here is that you ensure that at the very start, the sector classification is made correct so that you can accordingly plan the timelines of your India entry and have a very smooth experience, which is also compliant. Moving on, step two, which is choosing the right business entity type. Now, this is a very strategic decision because it totally depends upon the nature of your business activity in India. So there are four key types which we'll cover very briefly and along with its advantages. So first one is a company. So there are basically two types, majorly private limited and public limited. So whether it's a privately owned or a publicly owned company, it provides foreign businesses full operational control over their business operations in India. So this is a go-to model for foreign businesses in case if they are looking to have scalable, strong presence in India. Second, which is limited liability partnerships. Now, there are basically limited liability partnerships has a key advantage of lesser compliances versus a company. But limited liability partnerships has also combines the benefits of traditional partnership along with several flexibility in the management and running the operations with ease. Thirdly is foreign establishments. There are key three forms here. First one is the liaison office, which basically acts as a communication channel between parent and the Indian stakeholders. However, important thing to note here is that this liaison office cannot have any commercial or revenue generating activity in India. Second is a branch office, which is typically allowed to do the same business as its parent company, but within a defined scope. Thirdly, a project office, which can be set up only for the specific duration of a project and to execute and undertake that particular project only. Lastly, is joint ventures, which also offers great opportunities for foreign businesses who are looking to have synergies with Indian businesses in terms of local market knowledge, shared resources, shared expertise, and technical know how. So, in our experience, these four are major types. However, making the right choice of your business entity depends totally on your strategic goals and long-term operational requirements in India. If you're looking to have strong presence over long term in India, a company is a go-to model. And thus, in the next few slides, we'll quickly dive a little bit deeper into the setup requirements for a company. So the key requirements for setting up in India, very broadly, are these five ones. First one is having nominal paid up capital. This particular requirement, there is no minimum threshold which is prescribed. That's very important to note. Thus, you can also have like a 1 rupee company in India. However, what in our experience we would recommend you to budget for a few months of expenses and bring in that much amount of capital at the time of incorporation itself. Second one is having local registered office address in India. Third, having one local company secretary, which gets applicable only if the paid up capital is above 100 million INR. Fourth one and the fifth one, which are the key ones, is having minimum two directors on board of the Indian entity. Out of that, one of them has to be resident in India. And lastly, having two shareholders, bare minimum, to set up an company in India. Now, diving a little bit deeper into the shareholding structure. So there are typically two major models which we would recommend. This is very important to structure it right, considering it can have long-term impact on your control, ownership in India, as well as how you run your operations in India. So the option one is setting up a wholly owned subsidiary structure, wherein the parent company would hold, say, around 99.99%, like the majority stake, and a nominal stake can be held by another associate entity within the same group. So that way, the entire ownership and control remains within the group. Of course, this in case if you're not looking to set up like a 100% subsidiary, this shareholding percentage can be changed flexibly depending upon the strategic goals of the company. Second option is where, in case you do not have another associate company within the group, the parent company can hold majority stake and nominal percentage can be held by an individual. Further, it's important to note that in such a case, you can also have individual shareholding. Moving on. So while we have defined the ownership structure right, another important aspect to be covered is you ensure you develop a very tax effective business model. So, as you would be aware, India has a very favorable tax environment with corporate tax of around 25% and GST being in range of 5 to 18% across sectors. But one important thing is that India has double taxation avoidance agreement with several countries, around 95 countries across the globe, which includes major economies such as US, UK, Germany, Australia, Singapore. So accordingly, this can be a very important tool to optimize your global tax position. So overall, with right advisory from the very start, in terms of your drafting of your drafting, crafting your shareholding structure, having a very tax effective business model, in long term, you can have a very successful business operation in India. Another important aspect which can be covered at the time of your India entry strategy is the government incentives and the initiatives which government of India has recently brought up. One such important one is the production linked incentive scheme. This scheme basically covers around 14 sectors which are labor intensive and rewards in range of 4 to 6%, as mentioned by Manish earlier. Some of the key sectors to bring in here is mobile phone manufacturing, automobiles, and food processing. So these are certain sectors which have benefited the most out of this. And also the government of India has recently laid that they are bringing in further sectors complementary to the 14 sectors laid down here. So this would be a further add-on benefit for companies looking to enter into the manufacturing space. So, along with PLI, there are several strategic zones. One such is GIFT City, as mentioned by Manish. And now I would like to hand over to my colleague Meet, who would basically run you guys through the setup process and the focus areas of GIFT City. Why is it an emerging, fast emerging hub across the globe to be considered? So, over to you, Meet.
Thank you, Bansi and Manish, for that insightful information on why India and how does mainland India differ in case of the other territories that are available. Let me help everybody explore the immense potential that GIFT City has. How can a business be set up in GIFT? Um, so, starting with GIFT City is the first operational smart city. It is India's maiden international financial services center, something which is comparable to a DIFC or a Singapore FC. It is strategically located in the state of Gujarat. It has seamless connections across India, very nearby to the Ahmedabad airport, internationally also connected to other diversified markets, etc. What sets it apart is the design for innovation, the global business attractions, the blending of the regulatory flexibilities, the digital first infrastructure, and the growth focus of the ecosystem. Overall, this becomes a very inviting jurisdictions for financial services sector specifically. So why one must consider GIFT IFSC? How does it become a compelling destination? Let's see the key benefits where businesses will derive its benefits out of by operating in GIFT IFSC. So one of the key aspects is the tax holidays and the exemptions that have been provided by the government in order to operate out of GIFT. So any business operating out of GIFT IFSC will enjoy 10 years tax holidays out of its 15 years tenure on the business profits earned, which is one of the major inviting points for any business to look at GIFT as a entry point for India business, etc. The other set of advantages is there is no securities transaction tax, no commodity transaction tax on the exchanges that are operating in GIFT City. So no capital gain tax is the another benefit for various instruments which are issued out of GIFT IFSCA. Lastly, there are zero GST levies based on the entities operating out of GIFT. So any exports made out of GIFT IFSC would be exempt from the levy of VAT or GST. Simplified regulatory frameworks. The regulatory frameworks have been simplified. One of the fast-moving regulatory changes have been introduced because of the unified financial regulator called IFSCA. They have introduced a single window clearance for all kind of applications. Since it is a special economic zone and also a financial services center, both powers have been combined and are governed or administered by IFSCA. This helps in for the entities to have a unique opportunity to just submit their application at one single window and understand the status very quickly. And this all is based on an online portal called SWIT. Um, Further, there are various sandbox regimes which have been introduced, various consultation papers which have been released. A lot of public comments have been invited, and based on the public comments, the final regulations have been drafted. In all, IFSC has been a welcoming regulator in terms of the other regulators available on the mainland basis. World-class infrastructure. So we saw a glimpse of the smart city approach that GIFT City has taken up. A lot of A-grade office spaces have opened up, a lot of smart utilities, high-speed data centers, 24/7 power connectivity, etc. are available in GIFT. Access to the talent pool. GIFT City is cornered or nearby the two major cities, Ahmedabad and Gandhinagar, which host IIM Ahmedabad, IIM Gandhinagar, near my universities, etc. So a lot of talent is available, especially in the financial and the tech segment around it. There are various government incentive projects. One of the latest project was the GIFT IFI project, which focuses on developing the financial tech players around GIFT City. The Unified Financial Regulator, IFSCA, has been enacted through an act in 2019. It is governed by SEBI, RBI, IRDA, and the pension regulator in the governing council. They are authorized to issue circulars, notification, and regulations around the IFSCA and its operational side of frameworks. SEZ status. SEZ status helps gift entities to enjoy 100% GST benefits. So any entity charging invoicing to gift IFSCA entities would not charge any GST. There would be an SEZ exemption applicable under the GST laws. There are various customs exemptions as well. Ease of doing business, since a lot of these uh, regulations are being amended, globally benchmarked. There's a lot of ease of doing business for entities looking at gift as an entry piece from an India perspective. Moving on to the focus areas in gift IFSC, I'll touch upon the major areas. Um, a GIFT is a full spectrum international services hub. Banking being one of the core areas out of GIFT. A lot of global banks like HSBC, Standard Chartered, Deutsche Bank, Barclays, etc. have set up their IFSCA units. It gives an emerging opportunities to such banks in order to conduct cross-border transactions, lending, ECVs, and tech-enabled financial trades from these units which are set up in GIFT IFSCA. Moving on, capital markets, uh, two major stock exchanges, India INX and um, NSE INX. Both have set up their shop in GIFT. There is a 22-hour trading window which is open for global investors. There is a dual listing possible mainland also in GIFT through these exchanges which are present. This gives an opportunity for the global investors to access the Indian markets through GIFT City, which is a fairly lesser in terms of the regulatory complexities in terms of the Indian markets. Recently, we have seen a lot of green bonds and ESG focused products being listed or issued out of GIFT IFSCA. The core elements which I would take up next is the asset management entities. Various funds, category 1, category 2, category 3 kind of funds have been launched out of GIFTs. Currently, 200 odd funds have been operating and licensed from the GIFT City entities. A lot of regulatory parity and clarity has been issued through various budgets amendments by the Finance Ministry. We recently saw ETFs and retail funds getting the same tax parity as the Cat 1, Cat 2, Cat 3 funds operating out of GIFT. Also, there is a push for relocation of funds from Mauritius, Cayman, and other jurisdictions outside India to GIFT in order to help them redomicile. There is a lot of regulatory ease and operational convenience for this kind of funds. We've seen BlackRock, multiples, etc., operating out of GIFT. The other sector which has been on focus is the insurance and the reinsurance piece. LIC, GIC, and various foreign insurance have set up their shop in GIFT IFSCA. Currently, in budget, they have proposed that tax policies issued by the IFSC intermediary offices will enjoy a full tax exemption. So a lucrative piece for insurance intermediaries in terms of operating out of GIFT. Apart from this, there are fintechs which are operating out of GIFT. Major the focus is on the AI-based technology, blockchain technologies, and also assisting the digital banking system. So overall, fintech enabled banking, fintech enabled capital markets, insurance, and uh, asset management entities is what the ecosystem offers. Apart from this, we'll see a very unique set of foreign universities. Two Australian foreign universities have already set up their shop in GIFT and are currently serving or educating 60 plus students, having the campus running on ground. Three UK-based universities are also in the process of setting up and getting the approvals. Alongside the exciting update from the mainland that UK universities also set up their campus in Delhi. Other than that, we'll see global treasury houses where ONGC, IOC, etc., can manage their dollar, their euro, their GBP based receivables and payables from the GIFT City uh, jurisdiction. Overall, there is a lot of push from a regulatory framework perspective, ease of doing framework perspective. And to conclude, I would just like to say why participants should look at GIFT, when they should look at GIFT, and how should they should look at GIFT. So if you're a bank, if you're a fund, if you're an insurance player, if you're a fintech, or an ancillary service provider like us, the time is now. I would ask Manish to conclude the webinar from our side. Manish, you're on mute.
Yes. Yeah. So thank you, Meet and Bansi. So just to conclude, based on my brief of India, Bansi's insight into mainland and Meet's insight into GIFT City, I think we have covered it all very quickly. Uh, we will take you through our suite of services that help companies like you to get an end-to-end comprehensive one-stop solution. So, Meet, can you just so our services are split into two parts. One is we'll help you navigate the entire roadmap for entering into India, whether mainland, gift, if mainland, which entity, if gift, what is the procedure, if an SEZ, what you have to do. So one is the entire setup and compliances related to setup, and then there's the entire ongoing compliances and the regulatory framework, day-to-day taxation, payroll, indirect taxation, international tax, and all those filings, etc., etc., etc. So that's the one-stop shop stuff that we offer. Opening the entire forum now for questions. We have proper 15, 20 minutes, and we can take a few more questions also if it goes beyond. Uh, uh, I think I'll just take a few questions that have come up. Um, okay, I think Mr. Jatin has asked quite a few questions. First is, can a foreign company set up a trading entity in GIFT City? Meet, that's to you.
So, yeah, thanks, Manish. So, a trading entity would mean basically in goods. I don't think this would be in the regulatory framework. Currently, financial services entities can look at GIFT. If you are in the business of of any services, etc., we can explore that discussion.
So, in short, trading entity for goods is not going to be possible into the IFSC framework, right? Then meet an anonymous attendee. So I don't know the name. Has asked for to share your thoughts on what type of businesses are permissible as per the CMI regulation in IFSC. I think CMI is Capital Market Intermediate.
Market intermediaries. Correct.
It's applicable to whom all? If you could share your insight into it.
Sure. So CMI regulations basically includes capital market intermediaries like stockbrokers, because there are a couple of stock exchanges already in GIFT. Stockbrokers have a use case for GIFT City basically. There are investment advisors, there are PMS,
Yes.
there are capital market products distributors, etc. So
I
this
think
kind of
yes,
businesses.
it covers. I think it covers everybody. It's like depository participants, clearing members, the entire ecosystem of capital market intermediaries, custodians, debenture trustees, credit rating, all of that. All of that is covered as part of the CMI regulation. Yes, if that answers your question. The other question that has been asked is, can you brief on tax on dividend capital gains to NRIs investing through GIFT City?
So that's a very interesting question. Definitely, there would be a lot of exemptions. It depends on the kind of products that you invest into and the kind of entity that you are operating from a dividend perspective. So I think we can discuss your detailed questions. If you can drop us an email and we'll get back to you in
Yes,
terms of taxation on this.
yes. Yes, we will be sharing our presentation to all the participants, so not to worry there. Another question is, can a foreign company established outside India open current account and manage their foreign receivables and payables? I think that that's again for GIFT City. I think that's a question for GIFT City.
Correct. So yeah, so we saw a regime on the global treasury management. So anything from a foreign receivable perspective in your foreign currency itself can be managed to gift. I think there's a use case in terms of ONGC and IOC from a India landscape perspective, but I think there are other entities which are also contemplating the setup from a treasury perspective, because all the income that you derive out of your treasury office will be exempt. You can enjoy the 10-year tax holiday provided by the government.
Yes, I think another question, which I think may be valid for most with me, whether MAT tax is applicable during the tax holiday period of 10 out of the 15 years.
So, Vijay, I think MAT is applicable, but if you take the benefits of 115 BAA provisions, MAT would go away in case you are a company.
Okay, and then I think Swapnil, your question is very specific. We'll address it separately. Uh, how much time, in your experience so far, takes to obtain prior approval from DPIT pursuant to PN3 for setting up entity in India from stakeholders of HK and China? I think Bansi, that's a question that you can answer.
Yeah. So in our experience, it has been taking minimum 6 to 9 months. Also, this is very subjective to the RBI officials and the submissions, etc. made. One important thing here is that you have to be able to justify why Indian economy will benefit by you as a Chinese or a Hong Kong company setting up in India. Maybe that is in terms of scalability, the employment that it will generate for the Indian economy, and such other key criterias which are defined. But yes, it's totally subjective. Approximately 6 to 9 months is what you can budget for in terms of timeline.
Uh, I think that's a good answer. So I think Chintan's question: in case of distribution business as per CMI and IFSC, the registered entity can do operations outside SEZ or outside India. I think, Meet, this is a question to you.
Yes, so there is this financial product that they can distribute out of GIFT City or other jurisdictions. But just a caveat here, the other jurisdictions regulatory frameworks also needs to be examined when we are talking about any products outside India. There can be regulations where you are required to register in that jurisdiction as well, because you are distributing their financial products.
Perfect. And I think whilst we are answering a couple of questions, I just want to draw all the attendees regarding our presence across 22 jurisdictions from the length and breadth of the world. We are having our presence. Our contact numbers and our email IDs are there. And I request all of you to follow InCorp India for continuous updates on this subject. Right. Getting back to the questions, I think Vijay has asked another question. Can a company directly list equity on IFSC without establishing a business presence in GIFT City?
Yes, Vijay, you can, if you are an Indian company or a foreign company, do a direct listing on the exchanges available in GIFT. There are certain caveats. No need for a physical presence in GIFT City office or in GIFT City area.
We've got another question on the chat. So, how is the tax treatment different, Meet, for Cat 2 and Cat 3 more from ESG or climate funds? I don't think there's a classification of funds here, but I think the differences between Cat 2 and Cat 3, Meet can answer that.
So broadly, Cat 3 funds, the taxation is at the fund level. Cat 2, the fund is at the investor level. So based on your investments in India, outside India, the tax treatment would differ. But broadly, the concept still remains the same.
I think, Meet, the question is more from perspective of on gift versus mainland. So I think the answer should be, I think you can clarify whether it's largely the same framework, right? Whether it is mainland or
Correct.
gift, the framework is still the same. Yes. Obviously, the tax rates, etc., depend on what is there through the registered entity in gift. Yes. And I think if you want to attempt Swapnil's question, very specific since we don't have any other questions. So in case of Swapnil, they're a public limited company in import exports in India and would like to set up an NBFC to support financial services specific for import credits through US Exim. In the US, our principal company is in steel bridges from few decades, can be set up in gift. So, Meet, you want to take this question?
Yes. So, Swapnil, there is a structure possible from an NBFC perspective. Receivable payables can be managed because trade finance is something that can be done out of gift. Particularly only for your company, I think we'll have to narrow down into the regulations, etc., to check that. But yeah, there is a use case that is possible from a trade finance perspective.
I think this is very similar to a separate regime in GIFT, which is specific to airlines, leases, etc. I mean, there was a pure carving out of that stuff. It's very similar for these kind of products that we can help you to get approvals for. So, uh, uh, our question is, how long does incorporation process take in the mainland in India? Bansi, that's a question to you.
So minimum around a month to a month and a half is I think you should budget for in terms of timeline to set up in India.
Okay. Okay. This I'm assuming is in the automatic route, right, Bansi?
Yes, that's right. Automatic route.
Correct, correct, correct. Another question is, Meet, can you please let us know the requirements for PO and CO under CMI regulation? The regulated entity is doing multiple businesses in IFSC, so do we need a separate PO and CO for each business line?
Thanks, Chintan. I think the CMI regulations have defined the PO and CO requirements. Broadly, it is related to the work-ex that they should have as a background in order to become a PO or CO. I think in PO it is 5 years. For CO it is flexible. I think recently in funds regime they have specified a 3-year minimum work-ex. In order to come to your next question, I think if you are in multiple business conflicting business, let's say you're doing an NBFC stuff along with the CMI entity, you will need a separate PO and CO because of the line of business that you're operating from. And there has to be ring fencing regulations which needs to be taken care of. Or both the regulation would speak differently about it.
Okay. I think another question, I think it's a pertinent question outside the regulatory landscape. What are the major infrastructure developments planned in and around GIFT City to support its rapid growth? I think, Meet, we
So
keep
a
on.
lot of construction is going on. I would recommend that if you can visit GIFT once and see how fast it's been developing. We've been here from last 5 years. We've been seeing it from being just a few buildings to now a lot of construction sites and a lot of new buildings coming up. So a lot of infrastructure push has been there. Having said that, the public transport is evolving big time. A lot of metro connectivity, etc., is in place. Bullet train is also under construction. A lot of transportation flexibility would be there from different cities, especially from Mumbai, etc. So, a lot of exciting developments happening in and around GIFT.
And if any other SEZ-based company can get listed with GIFT for bring investment into India as SPV. So I think
It's
this
a structural
yes,
question, but
absolutely.
I think listing in GIFT is possible for any private or public entity in the exchanges available here.
Yeah.
Of course, bringing the money, utilization of the money would be secondary. The listing is possible.
Yes. Another question from Priyanka is, what is the motive of having different tax treatment for Cat 2 and Cat 3 in GIFT as in tax at fund level and investor level?
Again, a very broad question. It is the structural question basically. I think It's similar to somewhere you will see in other jurisdictions as well. Cat 2 and Cat 3 have different kind of tax treatment, and that is where it is adopted from. I don't see a motive behind it. It's a structural question,
I think there are,
largely.
I think there are two aspects here, if I can add. I think one is parity between mainland and gift in terms of treatment. Second is flexibility for investors, right? I think certain times funds are structured where investors want flexibility in terms of oversight on their tax payments, and other structures require the fund to do all the administration. So that's the second piece. The third piece is that essentially gift has been modeled to replicate structures across the world, whether it is Mauritius, Cayman, etc. And this is a very, very evolved structure globally. So when they are thinking of domiciling, re-domiciling, or actually starting afresh and in a new format, they should have a framework which is very, very similar. So essentially, I think it is about flexibility. Nobody is asking us and forcing us to do a Cat 2 or Cat 3. It's about the flexibility that the structure.
Correct. And also the regulatory requirements for Cat 2 and Cat 3 would differ. The allowable investments, etc., would differ. So based on your structure, the tax treatment would differ because 3 would be more complex than the Cat 2 structure overall to speak.
Mansi, I think one more question to you. It's a very open-ended question, but I think it's worth taking a shot at. Is bank account opening easy in India? I
So,
think you do this
yeah.
for a living, so you can say how we wade through this maze, right?
Yeah, so basically, most of these foreign banks like Standard Chartered, HSBC, DBS, they have digitalized the entire process. They don't require any hard copies. And generally, what we do at the time of incorporation, all the apostille notarized documents, what we get, we directly submit it to these bankers so that your incorporation process is very smooth. Bank account opening process is overall very smooth compared to you going down and coordinating with the bank, etc. But overall, minimum 15 days as you should budget for bank account opening. But and one important thing is you don't even need to come down to India for opening up the bank account because it's fully digital. But 15-20 days is bare minimum for bank account opening.
I think on a practical note, I want to just add one point. There is a lot of noise that happens, especially in jurisdictions like India, Singapore, that bank account opening, etc., is very, very difficult. It's actually the advisors who are guiding these companies as to how you can get through the application in one shot. So, because we've experienced across products, companies, structures, investors globally, we have a very clear understanding of how we can get through this very quickly. It's very important, therefore, to go to the right advisor who
Banker.
has experience for opening such accounts. Yeah. I think I'll take the next one. As far as listing guidelines, yes, listing guidelines are there. It's very clearly listed down in the IFSC, but still we can share a copy of that. With respect to, I think, Meet, we have done a seminar on this, but you can just answer Chintan's question. With respect to cybersecurity and cyber resilience framework issued by the IFSC, if the registered entity do not have a parent entity and having a less than 10 employees, is it applicable? I think that's a question
Yes,
which
the framework is applicable,
we.
and a lot of policy drafting and appointment of
So Chintan, just
CSIO,
to make it,
etc., would
yeah.
be required.
So Chintan, to make it very simple, every registered entity, this is applicable.
Correct. There was an exemption when the parent entity is following a typical cybersecurity guidelines from other regulator perspective, can be SEBI, etc., and having less than 10 employees. So I think the specific question is from that perspective that if there is a parent entity and there is a less than 10 employee, it would be exempt. But unfortunately, in this case, it wouldn't.
Yes.
Would it be easier to process in terms of timeline and cost to get money from overseas? What would be the right way, ECB or an additional capital issue?
So ECB requires adherence to the guidelines is prescribed by the RBI, which are quite not like they're straightforward, but it can get cumbersome because you need to do monthly reporting via the AD banker to the RBI on the principal amount, the interest yield, etc. So that's the reason we generally advise if it's possible to do a capital infusion via say a rights issue or private placement to bring in the amount of share capital because it's like a one-time process of reporting to the RBI versus a monthly reporting under the ECB framework to the AD banker.
Got
I
it.
think we don't have any more questions. Yeah. So I think we've had a very insightful session. I think hopefully we will share this presentation to all of you. Please feel free. I have the final slide open for you all to note down our contact numbers, our email IDs, and our LinkedIn handle. Do follow us and stay updated. Thank you so much. Thank you, Meet. Thank you, Bansi, for the wonderful conversation. Thank you to all the participants. We had a great time answering your questions. Thank you so much. Thank you.
Pleasure. Thank you.
Thank you.
Thank you.